Australia went 28 years without a recession. No other developed country came close. The same four forces that made that possible, the floating dollar, China, immigration, and the RBA, are also the reason your rent keeps going up. Your mortgage just got more expensive for the third time this year, and an entire generation can't afford a home. The shield that protected the economy is the same thing that's costing you money right now. This video shows you how. Here's something that should bother you more than it does. In 2001, the United States had a recession. In 2008, nearly every developed economy on Earth collapsed. Banks failed. Governments fell. Entire industries disappeared overnight. In 2020, a global pandemic shut down the world. Through all of that, one country on the planet managed to go 28 consecutive years without a single technical recession. 28 years. No other developed nation came close. That country was Australia. And right now, in 2026, you're paying $2.45 a litre for petrol. Your mortgage just went up for the third time this year. The unemployment rate just hit its highest point since late 2021. Groceries cost more than they did 12 months ago. And if you read the news, you'll see the word recession appearing in headlines again. Not as history, but as a warning. So either the shield that protected this country for 3 decades is cracking, or it was never protecting you in the first place. This video is about both of those possibilities, because they might be the same thing. By the end of it, you'll understand how Australia built the most impressive set of economic defenses any country has assembled in the modern era. You'll understand why those defenses worked against the dot-com crash, against the global financial crisis, against a literal pandemic. And you'll understand why, despite all of that, your life feels more expensive every single year. Because here's the thing nobody tells you about Australia's economic miracle. The shield and the wound might be the same thing. What if the same forces that kept this country out of recession for 30 years are also the reason your rent keeps climbing, your savings buy less than they used to, and an entire generation can't afford a home? What if the price of never having a recession was paid, slowly, invisibly, by you? That's not a rhetorical question. That's the question this video answers. And to answer it, we need to go back, not to a boom, to a disaster. Picture Tom. It's 1991. He's 43, works at a steel fabrication plant in Wollongong, south of Sydney. He's been there 16 years. One morning, his supervisor pulls the crew together and tells them the plant is cutting shifts. A month later, it's cutting jobs. Tom's one of them. He walks out with a box of his things, drives home, and sits in the driveway for 20 minutes before going inside to tell his wife. He's not alone. Across Australia, unemployment is climbing toward 11%. In some parts of Western Sydney, it's closer to 20%. The country is in the worst recession since the Second World War. Businesses are folding, houses are being repossessed. The queues outside Centrelink offices stretch around the block. And the treasurer at the time, Paul Keating, says something that will follow him for the rest of his career. He calls it the recession we had to have. That phrase made people furious. But here's the part most Australians never learned. Keating wasn't being callous. He was making an argument, a brutal, politically suicidal argument, that Australia's economy had been living on borrowed time for years, that the structures underneath it were rotten, and that unless those structures were torn out and rebuilt, the next recession would be worse. And the one after that. And the one after that. The Australia of 1991 was, economically speaking, a car without airbags. It drove fast. It felt fine. But the moment it hit a wall, there was nothing between the passengers and the windshield. Why? Because Australia in the 80s and early 90s was still running on a model built for a different era. High tariffs protected domestic manufacturing from competition, which sounds nice until you realize it also made Australian products expensive and uncompetitive. The financial system was heavily regulated in ways that limited how quickly banks and businesses could respond to change. Interest rates were set with one eye on politics and the other on tradition. And the Australian dollar was managed, not free, meaning the government had to actively intervene to keep its value stable, which cost billions and didn't always work. When the recession hit, there were almost no shock absorbers. The car hit the wall and people went through the windshield. That's the world before. That's where this story starts. Not with success, with failure. Because everything that came after, the 28-year miracle, was built in response to that failure. I'm going to be honest. The first time I tried to map out the reforms that followed 1991, I got lost in the detail. There's a lot, so I'm going to do something that will annoy economists, but hopefully save your sanity. I'm going to simplify it into 4 shields. 4 structural changes that, together, explain why Australia stopped falling down every time the world tripped. The first shield was the floating dollar. Now, technically, the Australian dollar was floated back in 1983 under Bob Hawke and Paul Keating. But it took years for the full effect to be felt. Here's what floating means in plain language. Before, the government decided what the Australian dollar was worth compared to other currencies. After, the market decided. Supply and demand. And that matters enormously during a crisis, because when the world economy slows down and demand for Australian exports drops, the dollar drops too, automatically, which makes Australian goods cheaper for the rest of the world to buy, which cushions the blow. It's like having suspension in the car. The road still has potholes, but you don't feel every single one in your spine. The second shield was China. In 2001, China joined the World Trade Organization. And what followed was the single biggest commodity boom in Australian history. China was building cities from scratch. It needed iron ore. It needed coal. It needed gas. And Australia had all 3, in enormous quantities, sitting in the ground in Western Australia and Queensland. Money poured in. Mining towns exploded. The terms of trade, which measures the ratio of export prices to import prices, hit levels that hadn't been seen since the wool boom of the 1950s. Australia was, quite literally, digging wealth out of the ground and shipping it north. The third shield was immigration. Australia had always been a migration country, but from the late 90s onward, the intake accelerated dramatically. More people meant more workers, more consumers, more demand for housing and services. And here's the part that matters for recessions. Population growth acts as a floor under the economy. Even if spending per person slows down, if you keep adding people, total spending can still grow. GDP is, after all, just the sum of what everyone produces. Add more everyone's, and the sum goes up, even if each individual is standing still. The fourth shield was the combination of the Reserve Bank of Australia and the government's willingness to spend. The RBA adopted formal inflation targeting in 1993. Keeping inflation between 2 and 3% became the explicit goal. That gave the RBA a clear mandate and, crucially, independence from politicians. When inflation rose, the RBA raised rates. When the economy slowed, it cut them. No permission needed. And on the fiscal side, government spending, Australia proved repeatedly that it was willing to open the checkbook fast and hard when crisis hit. Those 4 shields: floating dollar, China, immigration, the RBA, and fiscal firepower. That's the architecture. That's what was built in the rubble of 1991. And in 2008, it faced the ultimate test. Picture Sarah. She's 26, working her first real corporate job as a junior analyst at a consulting firm in Melbourne. It's September. She walks into the office and the TV in the kitchen is on. Lehman Brothers has collapsed. The footage is surreal. People carrying boxes out of a skyscraper in New York. Within days, stock markets around the world are in freefall. The ASX drops more than 40% from its peak. Sarah's manager calls a team meeting and says, very calmly, that they should all be prepared for a difficult few months. She goes home that night and starts updating her resume. Every developed economy on Earth went into recession that year. The United States, the United Kingdom, Japan, Germany, France, every single one, except Australia. That's wild when you think about it. How? The four shields fired simultaneously. The Australian dollar dropped from about 98 US cents to 60 in a matter of months, which made exports cheaper and cushioned the blow to mining and agriculture. China launched its own massive stimulus, which kept demand for Australian iron ore and coal alive. And the Rudd government did something that was, at the time, controversial, and is now studied in economics departments worldwide. It went hard on fiscal stimulus, fast. $900 direct to bank accounts for most Australian taxpayers. Billions more into school buildings, insulation, roads. The idea was simple. If people and businesses stop spending, the government has to spend instead. And it has to do it before the fear becomes self-fulfilling. It worked. Australia didn't just avoid recession. It barely slowed down. GDP growth dipped to about 1.4%. In a year when most of the developed world was contracting by 3, 4, 5%. I had to double-check those numbers before recording. They still seem improbable. But here's where the story gets complicated. Because the shields didn't just protect Australia from the GFC. They also set up what came next. Low interest rates, designed to keep the economy moving, also poured fuel on the housing market. Prices in Sydney and Melbourne began climbing at rates that made even optimistic property investors nervous. Immigration, which had kept demand alive during the crisis, also meant hundreds of thousands of new arrivals every year, competing for housing in cities that weren't building fast enough. And China, which had saved Australia's mining sector, was now so dominant in the trade relationship that any slowdown in Beijing sent tremors through the entire Australian economy. The shields worked, but they had side effects, and nobody was in a hurry to talk about that. Then came 2020. Picture Priya. She's 31, an emergency nurse in Brisbane. It's March. The world is shutting down. Flights are cancelled. Borders close. Restaurants, pubs, gyms, cinemas, everything stops. Within weeks, the Australian economy contracts at a speed that makes the 1991 recession look gentle. GDP falls 7% in the June quarter. 7. The largest single-quarter drop since records began in 1959. Australia is, technically, in recession for the first time in 28 years. But it doesn't feel like a recession. Not the way 1991 felt. Because the government rolls out JobKeeper, a wage subsidy that pays employers to keep workers on the books, even if there's no work. Millions of Australians receive it. Job seeker payments are doubled. The RBA cuts the cash rate to 0.25%, effectively zero. The shields fire again, harder than ever, and it works. Again. The recession lasts 2 quarters. By the end of the year, the economy is growing. By 2021, unemployment is falling. By 2022, it hits 3.4%, the lowest on record. Quick pause. Let that sink in. From 11% unemployment in 1991 to 3.4% in 2022. From the worst recession in a generation to the shortest, that's the arc. That's 30 years of shield building in action. But, and this is the part I wish I could skip, except it's the most important part of the whole video, something broke along the way. Stay with me. The next section is where everything connects. Picture Josh. He's 32, a FIFO worker, fly in, fly out, working in the iron ore mines in the Pilbara, Western Australia. He earns good money, really good money. His super balance is growing. His salary puts him comfortably above the national average. On paper, Josh is exactly the kind of Australian the economy was built to serve. But his younger sister lives in Sydney. She's a teacher. She earns a decent wage, but she's been renting for 8 years. She's saved what she can, but every time she gets close to a deposit, prices move again. She went to an auction once in Marrickville. She watched the price sail past her limit in 30 seconds. She hasn't been to one since. Josh can't figure it out. The economy is growing. The news says GDP is up. The treasurer talks about resilience, but his sister can't buy a flat. Her rent goes up every year. Her groceries cost more. And when she looks at the GDP per capita numbers, the ones that divide total growth by the number of people in the country, she finds something that doesn't make the news nearly often enough. GDP per capita fell for 7 consecutive quarters. From early 2023 to late 2024. 7 quarters, the longest per capita recession on record. That means the economy was technically growing, but the growth was entirely absorbed by population growth. Each individual person, on average, was producing less, earning less in real terms, and falling behind. That's not a recession in the textbook sense. But if you're the person whose rent just went up and whose savings are worth less than they were last year, the textbook definition doesn't matter much. And then, 2026 arrived. Picture May. She's 29, works in marketing in Sydney. She's filling up her car at a servo in Parramatta. The price on the screen says $2.45 a litre. She does the maths in her head and realizes she's spending over $100 a week just on petrol to get to work. Her mortgage, variable rate, because that's what she could get, just went up again. The RBA raised the cash rate in February, March, and May. 3 hikes in 5 months, after cutting 3 times the year before. Her repayments are back to where they were at the peak of 2023. All those cuts undone. Why? Because a conflict in the Middle East disrupted oil shipping through the Strait of Hormuz. Fuel prices spiked. Inflation, which had been slowly coming down, shot back above 4%. The RBA had no choice, or at least, it felt it had no choice, but to raise rates again to try to control prices. And here's where it gets actually interesting. The RBA can raise rates to cool demand. It can make borrowing more expensive, so people spend less, but it can't do anything about the price of oil. That's set by global markets, by geopolitics, by decisions made in Tehran and Washington. The RBA is fighting inflation with one tool, interest rates. And at least half the inflation isn't coming from domestic demand, it's coming from outside. Meanwhile, unemployment has climbed to 4.5%. Businesses are warning about cost pressures. Insolvency rates are rising. Creditor Watch, Oxford Economics, and the IMF are all using phrases like risk zone and recession risk. The shields are still there. The floating dollar is still absorbing shocks. China is still buying iron ore. Immigration is still adding people. The RBA is still adjusting rates. But the shields are being hit from multiple directions at once. Oil shock, trade tariffs from the United States, rising global uncertainty. And for the first time in a long time, serious people are asking a serious question. Can the shields hold? I'm not going to pretend I know the answer to that. Nobody does. There are state-by-state differences, sector-by-sector dynamics, and global variables that would take a whole series to unpack properly. But here's what I can tell you. And this is the part that changes how you see everything. The 4 shields that kept Australia out of recession for 28 years are the same 4 forces that created the problems you feel in your daily life. This isn't a coincidence. It's a structural feature. Shield 1, the floating dollar. When the dollar drops, exports get cheaper and mining stays profitable. But a lower dollar also means imports cost more. Your electronics, your petrol, your overseas holiday, anything made overseas, it all gets more expensive. The shock absorber that protects the economy charges you at the checkout. Shield 2, China and mining. The mining boom brought extraordinary wealth into Australia. But it also inflated the currency during boom years, which made it harder for other industries, manufacturing, tourism, agriculture, to compete. Economists call this Dutch disease. The mine gets richer, the factory closes. The economy looks great on paper, but the jobs are concentrated in fewer places and fewer sectors. And when China slows down, as it has periodically, the entire country holds its breath. Shield 3. Immigration. More people means more GDP. But more people also means more demand for housing in cities that were already struggling to build enough. Sydney's median house price crossed $1.4 million. Melbourne's is nearing $1 million. It's not the only reason housing is expensive. Tax policy, zoning, construction costs all play a role. But sustained high immigration in cities with constrained supply is one of the biggest factors. The shield that kept GDP growing also kept house prices climbing. Shield 4, the RBA and fiscal stimulus. Cutting rates during crises kept the economy alive. But years of low rates also meant cheap borrowing, which meant more money flowing into property, which meant higher prices, which meant more household debt. Australian households now carry some of the highest debt-to-income ratios in the developed world. And when rates go back up, as they have 3 times already this year, that debt becomes a weight around every borrower's neck. The shield and the wound are the same thing. That sentence is the entire video in 8 words. I know. I had the same reaction the first time it clicked. The structure of Australia's economic defences is, honestly, one of the most impressive things any country has built in the last 50 years. A floating currency, a massive commodity base with a hungry buyer next door, a growing population, an independent central bank with a clear mandate. Most countries would trade a limb for that combination. But the fact that almost nobody understands how those same defenses created the cost of living crisis, that's the part that should make you pause. Now, before we finish, there are 3 mistakes I see people make about this, and I want to clear them up because they change the picture. Mistake 1. Australia never had a recession. It did. In 2020, GDP fell 7% in 1 quarter. That's a recession by any definition. The 28-year streak ended. What people usually mean is that Australia avoided every recession that other countries had, the dot-com bust, the GFC, and that's true. But the COVID recession happened, and the per capita recession of 2023 and 2024 was real, even if it didn't have the same headline status. Mistake 2. It was all luck, just China and mining. Mining helped enormously, but plenty of resource-rich countries had recessions during this period. Russia, Brazil, South Africa, Norway came close. What separated Australia wasn't just having the resources, it was having the institutional structures to absorb shocks. The floating dollar, the independent RBA, a government willing to spend fast. Luck was part of the story. Structure was the rest. Mistake 3. GDP is growing, so the economy is fine. This is the most dangerous one. GDP can grow while GDP per capita falls. If you add 300,000 people to the population and the economy grows by 1%, each person is, on average, worse off. That's exactly what happened in 2023 and 2024. The economy grew. People got poorer. If you only read the headline number, you miss the story underneath. So where does that leave you? Here's what I'd want you to walk away with. First, when your mortgage payment goes up, that's not random. It's the RBA raising the cash rate, which flows through to your bank, which raises your variable rate. And the RBA raises rates because inflation is above its target. Right now, inflation is being driven partly by domestic demand and partly by a global oil shock that the RBA can't control. You're paying for a war you didn't start, through a mechanism most people can't explain. Second, when you hear the economy grew by 2.6%, ask the next question. What did GDP per capita do? because that's the number that measures whether growth actually reached individual people. If it didn't, and lately it often hasn't, then the headline is telling you a story about a country, not about your life. Third, and this is the one I wish someone had told me years ago, you can check this yourself. The ABS publishes GDP data quarterly. The RBA publishes its statement on monetary policy with forecasts and analysis. MyGov shows your tax, your super, your hex balance. The information isn't hidden. It's just never been explained in a way that makes you want to look. There's a whole rabbit hole about monetary policy theory, whether raising rates even works the way the textbook says, whether inflation targeting is the right framework for an economy like Australia's, that I'm not dragging you into today. If you want to go deeper, the Productivity Commission's reports on productivity and economic performance are genuinely excellent Australian-specific resources. And if you want a plain language starting point for personal finance, The Barefoot Investor remains one of the best things written for Australians about money. Every situation is different. What you've just learned is the framework, not the answer for your specific circumstances. Let me pull it together. Australia built 4 shields after the disaster of 1991. A floating dollar that absorbs external shocks. A resource base supercharged by China's rise. An immigration program that keeps the population and the economy growing. And a central bank with the independence and the tools to act fast when things go wrong. Those shields worked. For 28 years, they worked against everything the world threw at this country. The dot-com crash, the GFC, a pandemic that shut down civilization. But those same shields, the cheap money, the population growth, the resource dependence, the constant intervention, also built the housing crisis, the cost of living squeeze, and the growing gap between what the economy produces and what individual Australians actually feel. The shield and the wound are the same thing, and once you see that, every headline about the Australian economy reads differently. Most Australians will live their entire working lives inside this economy without ever understanding what held it together or what it cost them. Not because they're not smart enough, because nobody ever explained it. If you're now the person who sees both sides, the miracle and the price, you've already changed the conversation, not just for yourself, for anyone you talk to about money, about housing, about why things cost what they cost. That matters more than one video. Now, remember May, standing at the servo in Parramatta, watching the numbers climb past $100. She's not confused because she's bad with money. She's confused because she lives inside an economy that was engineered to never break. And nobody told her that the engineering had a cost. Now she knows. And so do you. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor. But understanding the system you live inside, that's not advice. That's the starting line.